high return on equity, ROE. What did you specifically mean by that, and why is that important?
So let's go back to the establishment of Berkshire Hathaway. So Berkshire Hathaway was a textile mill that was in decline, and Buffett acquired this business, and it was a cash cow. And that cash cow was used to finance the acquisition of other businesses. And the Berkshire Hathaway name stuck. They just took the name of the textile and put it on the flag, the masthead, and the rest is history. So the key is you want assets that throw off cash flow so that when Mr. Market, either public or private, has a dislocation, you have a move to make. You have liquidity. You have liquidity through the cash generating power of your assets. So one of the metrics that Buffett likes is return on equity. Return on equity is the net income generated by an asset divided by the equity cost of the asset. He likes 20%. If you look at the free cash flow generation of Berkshire Hathaway in a given quarter, even, it is substantial. He's generating so much cash flow every quarter. When there's a market dislocation, again, he's got the liquidity to make a move. And by the way, his cash flow generation is even higher for wholly owned businesses. Berkshire owns like 80 plus businesses. And so the free cash flow that's generated by those firms, he can access and tap, as opposed to having to rely on a dividend yield in public markets. And that's a big difference. Okay, let me illustrate with a simple example. JP Morgan has a return on equity of 15% plus, which is extraordinary for the United States as the largest bank in the land. 15% return. Talk about scalable compounding. However, the dividend JP Morgan pays is relatively paltry. It's a couple points dividend yield. If you're Berkshire Hathaway and you own that asset outright, the cash flow stream you access to is the full 15%. You can do a lot with that. So those are the reasons why, like See's Candy, for example, he bought decades ago, has returned over 80 times its initial capital. The idea that you can harvest the cash flows and then internally compound. Internally compound is like a word that investors have forgotten in the go-go 2010s, which are tech-oriented. Everything went up and to the right. Things went up and to the right because of earnings growth and because of multiple expansion. But that idea of internal compounding, it's like, hey, how do I take cash flow and plow it back into my business and grow that business? If I have return on invested capital that's positive, let's call it 20%, and I have incremental projects that will generate that return of 20%, I have cash flow and I can invest in my own business and grow. That's a wonderful thing. That's what JP Morgan has done. So that's the opportunity that a family office has in the private markets. Because if you're buying JP Morgan today, you're buying that asset at a price to tangible book value that is expensive. It's a great business, right? Whereas if you access opportunities in the private markets that are less covered, less picked over, for example, lower middle market firms where private equity doesn't play, or those firms cannot access financing, the multiples are cheaper, where there's an opportunity to consolidate, perhaps, there are different ways to approach it, then you can build a machine that also internally compounds with the cash flow generation of the business.